Hey everybody, it's John King. It is Friday, the 11th of October, and I'm here with my weekly market update. Man, there has been a lot going on over the last week and over the last month. If you haven't been paying attention, interest rates gave us a major head fake, a major look, but didn't really deliver what we thought they were going to deliver, and it's kind of scary. The volatility of the market is huge. And so I'm going to jump right in and share with you what I am seeing right now. As a matter of fact, I'm missing one of my little banners here that I like to have float over my head. So let's do this guy. Is that the one I want to do? Hold on. Let's do that guy. There you go, a little bit smaller. All right, so let me dive right in and tell you exactly what is going on. And that is the Federal Reserve made it clear a month ago, almost a month ago, that, hey, we're lowering interest rates. But it's not going to be as smooth of a ride as you think. We thought the Fed was our friend. We thought the Fed was on board and was going to be doing everything that we expected, that we've got our best friend, our ride or die that is right there with us and is on the same page that it is time to lower interest rates. And as a matter of fact, if you look at this chart, right here at the end of July, we saw rates hit their recent peak, July 25th, and rates were at 6.91, almost 7% for the average 30-year fixed rate mortgage. They had been as high as 7.5% back in April, as high as 8% back in October of last year. So we saw a peak here. We saw them fall and come back up and peak. We saw them fall, and now they're coming back up. And the question is this the peak? That's the worry. That's the question that we don't know. So why did this happen? Well, if we think about it, right here, we had the Federal Reserve. Basically, we saw 3 different times that we saw rates drop. Okay. And it all had to do with what did the Fed say and what's happening during that time. And so last year, the Fed saying, hey, I think we're done raising interest rates, and the market fell in early November. Then the Fed said at the end of December, for sure, we're done raising interest rates. And so the market fell. Rates got better. We hit 6.63 and we stopped right there, which, by the way, matches exactly where the rate is today. So you'll notice there's levels of where the rate will hit as a floor or as a ceiling. And we're at one of those levels. So we saw this level. As a matter of fact, I can draw a handy dandy little line here, right here. So I can go from right here all the way over to right here. And you can see that line. And so that blue line is representing what rates hit at the bottom in December when they went down. And then they started to go back up again, and then they jumped exactly down to that number again. Then they kept going up and up and up and up and up, and then they fell down and they went through that number. This is when the Fed said at the end of July, the time has come to start lowering interest rates. We're like, oh my God, it's our best friend. We're heading off on a road trip together. We got our ride or die with us, and rates fell straight through that level. Didn't break through it. It tried to once, it tried to twice, it tried to 3 times, and it failed until the 4th time. And then it went straight through to the bottom. Now we hit August 5th and we're like, oh man, this is a great ride. We're headed downhill. Everything is golden. Nope, things turn around. And the market gets a little bit nervous. Like, hey, maybe we got a little bit over our skis. Maybe we got a little ahead of ourselves. So rates had hit about 6.34. They jumped back up and they hit this level right here. So now we're testing it on the way up. And we hit it and we bounced back down. We come back up close to it. We come down, 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 down until we meet with the Fed. And the Fed, middle of September, says, hey, guys, we're going to lower rates. We're on board with you, but we're not going in the fast lane. We're not even taking the highway. We may be taking the city streets to go cross country with you. Maybe I'm your ride or die, but we're going to make this painful along the way. We're going to have the local train, not the express train. So it's going to be a bumpy ride. And that bumpy ride had some bumps in it for the last few weeks and a little bit of bumps. Most of those bumps were up some and down some and up some and down some until this week. This week was a bad week for interest rates. Now, again, these numbers are averages, and there's some cliffs that we hit where when rates go past a certain point, they jump up to another rate pretty quickly. We saw that right here. So we saw in the last week, we basically went from an average rate of 6.25 to an average rate of about 6.6%, literally overnight, literally in a 5-day time frame. And guess what number we're bumping up against? We're bumping up against the same number that we've bumped up against 4 times in the last year. And here we are doing it again. What does this mean? Well, it means if this number stays and we go below this, we're in good shape, because you noticed We touched it and stayed above, touched it and stayed above, touched it and stayed above. And so when we're above it, we're more likely to stay above it. When we're below it, we're more likely to stay below it. It's trends in trading algorithms and the way that the market cycles work. Those trends really are very, very strong. And that's a good sign that we're at the worst of the pain we're going to see right now. But it has to support. We have to see confirmation of that for the next week or two. We've got to stay at where we're at or lower interest rates. If it pushes through, we're in trouble. Because now it's going to take a whole lot just to get back to where we are today and a whole lot more to push us through to below that. Will we get there? The answer is yes. At some point, we're going to see rates back down in the 5s. I think in the next few years, we're going to see rates in the 4s, but it's going to take time. And every time we, including me, try to think, oh, this is it. I know we thought we were going to get it last time, but now is the time. And then it ends up not being the time. It ends up that something else comes along. This is a process. Nothing is as simple as it seems, and it's never a straight line. So be aware of that fact. Be prepared. If you're thinking about refinancing, you really should be prepared to pull the trigger when rates drop. We saw rates drop. I locked 5 or 6 people in the 2 weeks ago. And since then, a lot of people are saying, hey, I want to wait until rates drop again. That's fine, but get me your paperwork, get your credit pulled, get your income documents to me, get everything ready on the application so that I can push the button when the rate falls. It will fall at some point in time. It may not be next week. It may not be this year, but it will fall again. We are in a downward trend, but down is not a straight level process. So be aware of that fact. All right. Second thing I want to talk about today is renovation. Renovation is actually a really, really hot topic right now. Matter of fact, I just came across an article yesterday from Housing Wire that talked about renovation projects remain popular, but homeowners need help paying for them. And it got me thinking about how many of my clients I'm talking to right now that are exactly in this situation. And I realized I've been doing a disservice to you, my audience. I haven't been talking to you about how do you turn the home you're in to the home you love before you're ready to sell it. It's the saddest thing about home ownership is that so many people only make the house they love and wish they had right before they sell it. They know that, hey, if I can fix up the house, I'm going to make more money on it. So I'm going to make this house perfect so that I can sell it and get top dollar. But you didn't get to enjoy any time in the house with the features that you wish that you had. And so many people purchased homes in the last couple of years, actually in the last 4 or 5 years, purchased homes that weren't the exact home they wish they had. Now, there's the whole concept I've talked about over and over again about this is a first home for a reason because you upgrade to a bigger and better home. But there's some people who had the need to really cut back on what they were getting because they just couldn't afford it. Either because they couldn't afford it in 2020 and 2021 because house prices were jumping up so much and they couldn't bid high enough to get the offer, so they had to go for a less expensive home. Or in 22 and 23 and into 24, they bought a home that was less expensive because rates were crazy high. And so they had to compromise and buy a lower priced home. But either way, you're sitting in a home right now that you don't love. You bought it and you compromised and you could move. And you could say, you know what, I'm going to move down the street, but now you got to pay commission to the realtor to sell your home. You might have to pay commission to the realtor to help you buy the next home. You might have to pay commission to the realtor that is bringing a buyer to the home that you're selling. You got to pay to move. You still got to pay to fix up your house to some degree to get it sold. And you probably, hopefully, love your neighborhood, love the school district you're in, love your neighbors, so you don't want to move. Then fix the house where you're at. The problem is a lot of people don't have enough equity. They've either gotten a home that didn't go up very much in value because maybe you bought at the end of the run up in 2020 and 2021 and your house value's only gone up a little bit. Or maybe you're in a position where you took a low down payment loan and you've gotten some increase in value, but not enough to be able to pull cash out. Here's the limiting factor, and I have a solution. But the limiting factor is that most loans that tap into your equity will only let you touch 80% of the total value of the home. Not 80% of your equity, 80% of the total value of your home. What does that mean? That means that if your home is worth $500,000, you can only tap into 400,000 of that. Now, if you currently owe 400,000, you have 100,000 in equity. You owe 400. The house is worth 500. I see your questions, guys. I'll get to them in just a minute. You owe 400. Your house is worth 500. And you say, I have $100,000 in equity in the home, so I can take 80% of that, or 80 grand. And that's not how the math works. It's the house is worth 500. The most you can owe in total after pulling cash out is 80% of the value of the home, which is 400, and you already owe 400. So for a lot of people, they're saying, John, I don't have the equity. Even if I owed 350 on a house worth 500, I can only pull out 50 grand, and that's not enough to do the work I want to do. Why are you telling me I should refinance? Why are you telling me I should do a renovation when I can't get enough money out of my home? And the key here is doing what is called a renovation loan, because a renovation loan bases the value of the home on what it will be worth after the work is completed. So you have a home that's worth 500 right now that's going to be worth $590,000 when you put $100,000 worth of work into it. Or maybe it's worth, maybe you put $150,000 worth of work into it and it becomes worth 610. Now you're saying, John, wait a second, it's worth 500 and I put 150 into it. Shouldn't be worth 650. No, it doesn't work that way. The math doesn't work that way. Okay. By the way, I'm seeing your questions, guys. Great questions. I am going to get to them. I just want to finish this topic. And if you have questions on this topic, I might jump in while I'm talking. Otherwise, I'll cover all of your questions as soon as I am done on this topic. All right. But please ask your questions. So here's the deal. A renovation of a home does not give you a dollar for dollar increase in what you spent. You're looking at some things don't give you a direct financial return on investment. A pool is a good example. The value of a home with a pool is greater than the value of a home without a pool. But the difference is not what it costs to build a pool. If you put $50,000 into a home to build a pool, the value does not go up by 50 grand. It might go up by 10 or 20. Because now, hey, somebody can buy a home without a pool and put their own in if they really wanted to spend the 50 grand. And now they can design it the way that they want. So they're not going to pay you dollar for dollar for the pool you designed. But our renovation program has the ability to take that into account. I can loan you a greater percentage of what the home is worth, knowing that you don't get a dollar for dollar increase in value based on what you spent to renovate the home. So it's important to understand that as you're thinking about, I'd like to do renovation, even if you have no equity in the home right now, even if you owe $490,000 on a house that's worth $500, you can still do a renovation loan. You can still refinance the property, pull out cash because now the house is going to be worth. Now the cash doesn't go in your hand. The cash is held by us to pay the contractor directly. And there's a lot of opportunity to make this work well for you. And I'm going to continue to talk about this going forward. But that's about all I'm going to cover on that topic for today. So let me dive into what my questions are. So Mohammed asks, will home prices rise when interest rates go down? So obviously, Mohammed, I have to give my disclaimer that nobody can predict the future. Even the weatherman gets it wrong a lot. So I can give you historical context. In 1990s, the early 1990s, interest rates shot up significantly and house prices went down. The reason is simple, because the person who's shopping in that neighborhood can only afford to spend a certain dollar amount for the home. And when the interest rates went up, that person says, I can't afford to buy that home anymore, so I'm not going to buy it. And there's nobody else waiting in line to buy the home. So therefore, the seller who wants to sell their home has to lower the price in order to make the payment attractive to that person who was going to buy it when rates were lower. That's how the cycle normally works. But this time it didn't work that way. This time interest rates went up and a lot of people said, I can't afford that house in that neighborhood anymore. But a lot of other people said, but I can. There was enough people that wanted to buy that even if we took out half of the potential buyers, we did. We took out over half of the potential buyers, and the rest of them were still enough to keep enough demand on the supply of homes that were for sale. So prices did not drop. Why do I start with that story? Because it proves that there's a lot of demand. There's a lot of demand, even when interest rates are high. There is enough demand to cover the amount of supply that's for sale. But guess what? As rates go down, demand will come even higher. A lot of people who were looking for homes a year before rates went up got out of the market and said, I'm out. So we lost potential buyers that are going to come back when interest rates go down. And those buyers are going to now say, you know what? I really don't want to miss out this time. I've been renting for another 3 years because I didn't act aggressively enough in 2020 and 2021 to find a home. And therefore, I need to do whatever it takes right now to get a home. And those buyers are going to compete and they're going to drive prices up. So yes, I believe firmly home prices are going to rise when interest rates go down. The question is, how quickly are rates going down and how fast does the rate drop translate to new buyers? We saw a lot of buyers come into the market in the last month. Then we saw them kind of back off because rates went back up. So buyer appetite can be fickle. If you are looking for the best deal on a home, you want to buy before rates get too low. So Mohammed, hopefully that helps answer your question. I know you had another question here, but I'm going to get to Noah's first. You're welcome. Current lenders charging 1% as an origination fee on your Dream for All loan. Is that reasonable? Yeah, it's reasonable. I will tell you, depends on your loan size. There's other fees that they can be charging. 1% is about the lowest that I've seen. CalHFA lets you charge up to 3%. Most lenders that I see are anywhere from 1 to 2% on average on what they're charging for their Dream for All cost. And very few of them are at the low end of that unless you're a super high loan amount. So it depends on your loan size, but there's not very much revenue on these loans for the bank. Unlike a traditional loan where we're making money not only up front, but we're making money over the life of the loan, that doesn't happen with a Dream for All loan because that money over the life of the loan goes to the state of California. So therefore, banks are typically going to charge more on a Dream for All loan than they would on a traditional loan. As a matter of fact, on any down payment assistance loan, they're going to charge more than they would on a traditional loan. So 1%, that's a really good deal. I would also be a little nervous because if somebody is willing to be the cheapest, sometimes it means they're not very good at what they do. And if they're saying, hey, I'm going to do this for the absolute lowest cost, it means that's the only value they have to offer. And they may not be very good at structuring the loan. They may not be very good at navigating the challenges that come in the loan approval process. So just be cautious. I would say 1% is the cheapest I've seen. So if you want to say, is that a deal? That's a heck of a deal because I really haven't seen anybody that cheap unless you're like $1 million loan. So I'd be a little nervous about that person's experience and tenure and ability to navigate the waters. But answering your question directly, yeah, that's a great deal. All right, let's go to Mohammed's question. As a Dream for All buyer, do I have to refinance through CalHFA or any lender? You have any choice. You can refinance with anybody that you want. By the way, I'm interviewing for the job of being your lender, both for your purchase loan and for your refinance down the road. And I'd be remiss not to say, click the QR code to start the process if you're thinking about refinancing or purchasing or just getting advice from me. But no, you do not have to use CalHFA for your refinance. You can go through any lender as long as they understand the process of working with CalHFA to subordinate the Dream for All second mortgage. Because the first time you refinance, you have the option of not paying off CalHFA, but your lender has to understand how to work through that. I'm obviously thoroughly knowledgeable on that. So you got to be careful just to make sure your lender has the knowledge of that. If you're actually paying off CalHFA, then your lender doesn't need anywhere near as much knowledge because all they have to do is get a payoff statement from CalHFA for both the first mortgage and the second, and you can pay them off as part of your refinance. All right. Let's go to Maria. Maria, do you know how many Dream for All vouchers were extended and how many have been used in the capital region? No. I got a little bit of information and I have been trying to digest it. One of my clients called CalHFA and asked them how many vouchers were extended. And I think they said 600. Don't quote me on that. I don't have the numbers in front of me. I've been trying to analyze it. And they said, maybe they said 600 expired. I don't even want to give you the wrong numbers, but I've been trying to analyze that and say, okay, what does that mean compared to the original 1,750? And what does that mean as far as how many are truly left over? They're not giving us the data statewide. They're certainly not giving us the data regionally. And so I really don't have a good answer to that. I'm trying to take the data that one client got for me and analyze it to try and give you some usable information. right now I haven't had the time to sit down and really digest what does that mean and how could that affect, or what can I read into that mathematically on how many vouchers were used, how many are remaining. I think that there's a big number of people who pushed their extension through to December 31st, end of December, a little bit before the 31st. And I'm trying to extrapolate those numbers. I don't have enough data points to give you any good information. So I'm trying, I'm really, really trying, but I doubt I'm going to get anything regionally. The best I'm going to get is maybe something at a state level. All right. Mohammed has my last question, by the way. If you guys have more questions, feel free to post them. If you're watching live, if you're watching recorded, post your questions. I'll go back and answer them later. Mohammed says, if I decide to refinance a second time, can I take out a loan to pay CalHFA and the other loan and merge them into one? Or would I have to pay CalHFA the 20% earlier than later? So here's the deal. Oh, I'm sorry. You would rather, well, I'm not clear about the last part of that sentence. I would pay CalHFA 20% earlier versus later. So you always can take out a loan to pay off the CalHFA first mortgage and second mortgage. Whether it's your first refinance or your second one, you have the option of taking out that mortgage in a larger dollar amount. So you're refinancing to either pay off just the first mortgage and the loan fees, or to pay off the first mortgage, the second mortgage, the appreciation that CalHFA got, and the loan fees. So you can do either one. And my opinion for a lot of people is you are better off paying off CalHFA the first time you refinance if you can afford the bump in monthly payment. The earlier you pay off CalHFA, the better off you are, because you have a partner that is doing nothing but sitting there waiting to collect more of your appreciation. And it's kind of like having a silent partner in business that says, hey, I'm just waiting and collecting the checks. Well, they served a purpose, but the faster you can buy them out of your partnership, the better off you are. And so, yes, you can, when you refinance, make the loan big enough, and that really is the best way. Currently, I think that's the best way. Things can always change, and so I'm not a fan of giving generic advice, especially well in advance of when that time comes. But as I look at things, that is likely the best way. And today, anybody who did Dream for All a year ago, they shouldn't refinance yet. But if they were refinancing, the only way that I would be able to pay off the second is to do one big loan for the entire amount. And again, for a lot of people, if rates get down to the high fours, if you had a mid 6% interest rate, and we could get rates down to 4.8, 4.9, you could combine your first and your second, pay everything off, and have the same payment as you have today. To me, if you're comfortable with your payment, that's the dream. The dream is not lowering my rate so I can lower my payment. My dream is lowering my rate so that I can keep the same payment and get rid of my business partner in the state of California. Hopefully that makes sense. Noah says, thanks for the info on the origination fee. Do you know if CalHFA plans on giving an extension to people who just got off the wait list? I have a question. I have a client right now who's asking me that exact question. She got off the wait list about a month ago, and she'd rather wait until the spring. And she says, John, I really want to wait to start shopping until the spring, until the beginning of the year. And so I'm counting on getting an extension. And my answer to her is the same as my answer to you, Noah. I don't know. I can't speak for, I'm just looking, okay. So I can't speak for what CalHFA is going to do, because 4 months ago, when they first launched the program, and there was a FAQ in there that said how to go about requesting an extension. Before they even launched the vouchers, there was information about how to request an extension. So they built it into the system. But when I asked them at the end of June what the rules would be for granting an extension, they said, we're unwilling to say, we don't want to talk about it, we don't want to encourage extensions. So they're kind of downplaying it. What I sense so far is that they've given everybody an extension that's asked for it. And they haven't added any rules for somebody to say, hey, here's the stipulations of when you can get an extension. And I think part of that has to do with their fear that they could get sued for housing discrimination and saying, hey, how dare you say that I wasn't eligible for an extension when you said somebody else was? Well, if that really is their fear, then I'm pretty sure they're not going to stupidly change that policy after giving a bunch of people extensions and giving everybody extensions and then say, oh, well, now you guys just can't have them anymore. Although the law does say disparate treatment, treating someone differently, inappropriately, has to do with how you treat people in mass. And so if they simply publish a rule saying, effective tomorrow, we're no longer offering extensions, and they don't give extensions to anybody else, then that's not discrimination. That's a change in policy. Maybe they didn't have a written policy before. So you might say, well, John, it can't be a change in policy because there was no written policy. But the fact is they're allowed to add policies. And as long as they apply them unilaterally, it's not discrimination. So could CalHFA come in a month from now and say, we've decided it's not a good idea to do extensions anymore, and therefore we're removing the ability for anybody to do an extension effective blank date, effective today, effective yesterday. If they applied it unilaterally, it's not discrimination. So could they do that? They could. Do you want to take the chance? Do you want to take what you have in writing that says you have an expiration date 90 days from the day that you got it and say, yeah, but I'm pretty sure they're going to give me an exception to that? Well, so far they've given other people exceptions to it, but nowhere in writing does it say they will. The only thing you have in writing is that it says it expires on the 90th day. I don't know about you, but this is a golden opportunity to purchase a home. I'm not sure I'd want to count on the state not changing the rules, because the rule that we're counting on is not a rule that's in writing. And they can even change rules that are in writing. So I don't know if I'd go down that road, Noah. All right, Noah has another question. Do you know if Dream for All homes can eventually be turned into rental properties? This would be after a significant period of owner occupancy. Depends on what you call significant and depends on who you ask. So Fannie Mae backs the first mortgage. Fannie Mae says when you buy the home and sign your note, you are agreeing part of the deed of trust that says I intend to occupy within 60 days and to maintain occupancy for at least 1 year. That's all Fannie Mae requires. That's it. CalHFA's deed of trust says nothing about a longer time frame than that. So legally, you can turn the property into a rental property 1 year after you moved in. Now, I asked CalHFA that, and they said, well, these are first-time home buyers who were given an opportunity through this program, and it's the right thing for them to give the money back to the program when they're no longer occupying the property so that somebody else can utilize the money. And so we think that everybody who took out one of these loans that moves out and converts it to a rental property should refinance and pay us off immediately, because that money deserves to be in the hands of a deserving first-time, first-generation home buyer who needs the same benefits that you got when you bought the home. That's a lot of talk saying absolutely nothing. Because what they said is, we would like it. We think it's the right thing to do. It's, don't you want to be a good citizen and help out your neighbor? And I'm a good citizen. I want to help out my neighbor, but that's not the question you asked me. You asked me, can you turn it into an investment property? There is nothing in writing that says you can't, except for the fact that you must occupy within 60 days and maintain occupancy for at least 1 year. There is nothing else in writing about occupying the property. That is true for any property that you are purchasing, but you do have to be aware of when you go to buy the next property. The mortgage company on the next property is going to look at logically, why are you keeping that one as a rental and buying this one? It's called intent to occupy. Do you intend to occupy this new property as your primary home? Well, the truth is, I won't know if you're going to live there until I've already given you the mortgage. And at that point, it's too late. I'm not going to foreclose because it's too expensive to foreclose. By the way, sometimes we would foreclose. But for the most part, we want to nip it in the bud before you get the keys. Because when banks foreclose, they get punished by the federal government if they do too many foreclosures. So we want to make sure before you get the keys that we're not going to run into a situation that we may need to foreclose. So we are going to look at logic. And it says you bought this house that is a 2,500 square foot home in a nice neighborhood. And now it's a year later and you're moving out and you want to buy a 1,000 square foot duplex. Now, maybe that's a 2,000 square foot duplex, 1,000 per side. But the common sense says, why in the world would you move from a 2,400 square foot single family home to a duplex where you have somebody living right next door to you and you have half of the square footage? Unless you're downsizing, in which case that's about a lifestyle. That's about life stages and where you're at in your life stage. So my point is, be careful when somebody says buy a home and then rent it out after a year and buy something else and rent it out after a year and buy something else, because the mortgage system is not made to help people acquire a portfolio of investment properties using owner-occupied financing. You can work the system, but you cannot say, oh, I'm going to live in that home because that way I get better interest rates and lower down payment. That is not an acceptable answer. The answer has to be, I'm going to live in that home because it's in a nicer school district. I'm going to live in that home because I want to live in town and I'm currently living outside of town and I don't like not being close to hospitals. I currently live in town and I want to live outside of town because I don't like living so close to people. My current home is a 2-story home and I need a 1-story home because my mom's moving in and I need a bedroom downstairs to help take care of her. Like all of those things go to intent to occupy. So just be careful. I know this isn't your question, but as you own a property and you go to buy the next property and you're thinking ahead about, hey, I want to buy and then rent it out and buy something else, then buy the least desirable home first. That is the smallest home. That is the most number of units. Like if you're living in a 4-plex, you have 3 of your tenants living right next door to you. It is more desirable to live in a duplex where you only have 1 of your tenants living next door to you. And then it's more desirable to live in a single family home because then you have none of your tenants living next door to you. Then it's more desirable to live in a ranch home in the country because you have nobody living next door to you at all. So can you see that progression? You got to start on the correct end of the progression. You can't buy the beautiful home in the country that has nobody nearby and say, okay, now I want to buy a 4-plex. I'm going to move in. I won't believe you. I won't believe you. The mortgage industry won't believe you. So hopefully, Noah, that's a sufficient answer. I think I took it a lot further than what you intended. All right. I don't think we have any other questions. So gang, if you have a question, type quickly. Otherwise, just know that I am interviewing to be your lender. So if you have questions about anything, mortgage related, housing related, I would love to talk with you. You can scan the QR code above, get my contact information from my mobile app. There is a great calculator built into that mobile app as well. And if you're ready to start the loan process, use that same calculator, use that same mobile app to start an application, and we will take great care of you. So everybody, thank you so much for listening. Hope you have a wonderful weekend, and we'll talk to you next week. Bye-bye.